Good day, ladies and gentlemen, and welcome to the show on this Wednesday, the 28th of December 2022. You know what? Only 3 more days left of this year. Excuse me, but what have we seen so far this year? Really, it's been kind of like a delayed reaction. It's kind of like, when kids go out and they light off firecrackers and stuff, sometimes they light off a firecracker expecting the big bang, and it doesn't happen. It just kind of fizzles out. So, a lot of kids have been trapped this way. They got a big firecracker, right? They light it off and it fizzles out. Psst. And so they go over to check it. They pick it up and bang, it blows off right in their face. There's a little bit of a delay in there. They didn't expect, That's happened a lot of times before. This is just the same thing. I can see it happening here. With two things. The war going on over there. We were all worried. Especially when the war was first starting. There was an awful lot of talk about nuclear whatever, And it kind of fizzled out. Nothing happened. And then later in the war, there was more talk and nothing happened. So it's like the old thing about people crying wolf, And this is why the kids get caught with the firecracker. Is because it kind of fizzles out and they think, okay, it's over. And they go over and pick the firecracker up and then bang, it blows off. But not just the war aspect of it. What I'm talking about is the financial aspect. And this is even more potent. Because what we got happening is the Feds went through this long tightening cycle. And there hasn't been that big of a reaction. And I expected much bigger reaction. Almost like, I was watching them light a firecracker expecting it to blow off. Anyway, I'm going to get the chart started and show you what I'm talking about. So let's start the charts right here. Take a look at this. The Dallas Fed survey, unexpected drops. Respondents warn Biden political mentality means recession being planned for and acted upon. And it says here that the outlook for 6 months ahead remains negative. But here's the point I'm trying to make is, and what they're talking about here is things are starting to go downhill now. Like, in a really big way, It says a combination of increased costs, raw ingredients, illiquid consumers. That's a big one. We can't bypass that quickly. We got to talk about that. Illiquid consumers. This is going to be a big problem going into this year. The people out there are starting to get tapped out. And it's happening suddenly. All last year, the first part, going back into 2021 stuff, it was stimmy checks. And people had more than enough money. And everything was going along good. Then the government's done this big thing, We all know about it. The Federal Reserve and their tightening programs, and no more stimmy checks. In fact, they're moving in the opposite direction. They're hiring thousands and thousands of new IRS prosecutors to go out there and just draw all that money back in that they put out one time. Now they're pulling in. They're 90 some odd $billion a month of quantitative tightening. And it's just like it sounds. It's tightening. It's not good. It's tightening the economy. It's making things harder. It's drawing money out. And raising interest rates has the same effect. But it's a delayed reaction. And so right now, people are getting tapped out. It's really going to start to show that they don't have the money to spend on things. They don't have any discretional income to spend on things like they did have. And now they're just going to start tightening their belts and not buying so much. And that puts a strain on all these companies that produce things out there. So, illiquid consumers and the need to retain employees via increasing benefits has created a difficult environment. Couple that with Biden political mentality of things, and it's unhealthy for businesses. Significant downturn they're talking about here, up and coming. Recession is now being planned for and acted upon. So, it says we can feel things slowing down. Incoming orders have dropped as well. It says when interest rates go up, home construction goes down and will continue to go down. Demand is decreasing. Its business activity is going to be dropping for 2023. We're going into what we've been going through is a borderline recession / depression. It's going to make itself manifest as a depression in this next year. And, you know, at a certain point, it's going to get bad enough this year where the Fed's going to have to change direction on all this. And so what they're going to do is they're already preparing you. It's a mind thing that they're doing with you guys. They're telling you, inflation is peaking. That's a mind thing. It's like I remember there was this thing on Little Britain, I think it was, a show called Little Britain, and there was this guy who's a hypnotist on there, you know, and his mother was there, and he'd hypnotize his mother, and he was like, you're falling asleep, you're getting sleepy, and he'd snap his fingers, you're asleep, and now he'd tell her what he wanted her to do. This is what the government's doing with you. The exact same thing. They're like, inflation is peaking, it's peaking. Now you're asleep. Snap their fingers. Okay, now you're fully asleep. Now you're going to believe everything the government tells you to do. You're going to do everything the government tells you to do. You're going to be blind little servants, and you're going to blah, 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 blah. That's what they're trying to do with you. It's all BS. So, this is where we're going with all these things, and we're moving into it fast into this new year. So what's going to have to happen at a certain point is, it's going to become obvious to people. People are going to start to wake up and say, hey, I got no money to buy food. What happened? Where'd my job go? They're going to get upset. The government's got an answer for that too. It's called central bank digital currency, and it's called UBI. They're going to send you a payment. Well, that'll pacify you for a little while, but just think about what it's going to do to the dollar. You can't support all your citizens in the country, some 68% of the United States citizens who can't meet their payment obligations every month and have been living off their credit cards, living paycheck to paycheck, and the government's going to support all of them with UBI. What's that going to do to the dollar? It just doesn't work that way. You have to have a vibrant middle class to have a healthy country. This is the fall of the Roman Empire happening right here in front of us. We got to get in there, though. I can't go ranting too much today. I got to get in there and I got to talk about the markets a little bit and what's happening in the markets. We've seen a little bit of a rise in the price of silver and gold quite recently, and now she's dropping again. She's dropping today. She's down 46 cents at 23.57. Look at this, going straight down right now. It's exasperating for people who are holders of gold and silver, you know. The fact that the one thing that underpins the entire world's financial system, and it's in short supply, and the price keeps moving to the downside because they're so enamored with all these paper products, paper financial products that don't have any net worth at all. They really don't have any substance behind them. It's all fluff. But it's beautiful fluff. It's a kind of fluff that everybody wants. That fluff, the dollars. They want the dollars in their bank account. They're chasing after it. But they don't realize what really underpins the world's financial system is a very small little core of real assets. And mountains and mountains of debt. And this fluff I'm talking about is all that debt. You pay the debt back, the fluff disappears. Well, we're headed toward this peaking wave of the what the Fed was doing is going to create. The wave is peaking right now, and they're right. It is, to a certain degree, peaking. Inflation is starting to peak. But what comes on the other side of that is crashing down off of the sugar high of all of this debt that they've created into a depression. Well, the Fed can't allow that. So when that really starts to happen, when that really starts to get underway this year, they're going to have to pump it all back up again. This means more free, easy debt creation. It's just a never-ending cycle, and this means more inflation, higher inflation. Well, they haven't got inflation down to zero yet, or under 2%, their 2% target. They're still over that, even though it's starting to drop. Yeah, it's starting to drop, but they're not going to let it go down very far before they change directions again. Then the inflation's going to shoot up higher than ever. So you want to invest in the currency that is all just that debt creation? There's nothing behind it? That's a Ponzi scheme. Anyway, we're looking at gold at $17.99. Okay, cryptocurrency today. It's had some of the air leaking out of it. It's at $17.98, so it went down. It's crossed below 1,800. We're looking at 16,596 for Bitcoin. This is a bad sign for crypto right now. When you got Bitcoin holding up better than any of the others, that's a sign. That's bad when that happens. I've seen this happen a number of times before in the crypto space. When Bitcoin is the only one that's really holding its value better than the others, this means that anyway, it's a bad sign. It's not good. But how low could cryptos go before they turn around? Because I believe they're going to turn around ultimately in the end, and go in the opposite direction. But still, that's like there was a time when a $16,000 Bitcoin would have been considered like in a terribly high-priced Bitcoin. Like I remember when the price popped up to 20,000 and then it fell back down to like 3,500. But that was and then the next bull run after that went up to 68,000. But I mean, that's what it does. That's what cryptocurrency does. It goes through these bear and bull markets, tremendously powerful bear and bull markets on this stuff because it's a speculative asset so far. Eventually, in the end, it will become something more than that, but for now, that's where we're sitting with this stuff. Dow Jones Industrial Average is 112 points to the downside at 33,129. Basically, I guess what I'm saying to you guys is, when it comes to cryptocurrencies, you're going to have to be patient, but it's coming toward a inflection point where it's going to be a good place to. It's going to hit a buy-in spot. The spot where everybody says that's when you should buy it, when nobody else wants it. It's unloved and nobody wants to buy it, and the market's gone through the whole bear market cycle, and people are dismally rejecting it because it's just like, we don't want that anymore. We never want to buy that again. We hate that. That's when you should be buying it, when the price is down at its rock bottom price. And that's where I think where we're headed or getting close to at a certain point in a not too distant future. And then what does it do? Then it goes back in the opposite direction again. And you get a fantastic buy if you buy in at those rock bottom prices. But that's when nobody wants to buy. When all the people want to buy stuff is when the price is at its near its peak. That's when they all buy in. And it's mad. Everybody says, oh, I got to have some of that. I'm going to miss out. Fear of missing out. That's when you don't want to buy it. Now, cryptocurrency was in that spot when it was up at 68,000. Now it's down a fraction of that price. It's at 16,000 and dropping. And soon it might hit that sweet spot where nobody's going to buy it. Nobody wants it. It's easy to buy it then, and it's really cheap. But nobody will buy it when it's down like that. That's when everybody is like, I don't want to mess with that anymore. Anyway, the S&P 500 is 3,808. It's down 20 points on the day. I think we're in for some sort of a rude awakening for the markets coming into next year. Where the Fed's going to have to turn. They didn't turn this year. I'm surprised, but I think they're going to have to turn this year coming. And what about the war? Well, we got Ukraine over there saying we don't want to deal. They said we'll deal, yeah. Ukraine says okay, we'll deal, yeah, if all of the people who committed war crimes are prosecuted. And we got the Russians over there, and they're saying okay, well, we're not going to deal unless all the annexed territories are recognized or whatever. So I mean, there's no compromises yet to any of this, as far as I can see. I mean, I got a little bit excited when I heard there was going to be a peace talks in February. But now I can see what their terms are. Sadly, I don't think we're any further along toward this process than we were before. Because I don't think neither side is really sitting down with any actual commitment involved to try to get something done at this point. So it's still a big risk. This war is still a big risk at flaring into something bigger. Much, much bigger. Crude oil, $77.54. It's down $1.99. Bonds and rates today, what we're looking at is rise in yields on the long end and falling yields on the short end. We're looking at a U.S. 10-year at 3.88, starting to get up high toward 4% again. You notice that? It's up 2.5 basis points on the day. And the 30-year at 3.79 is up 3.6 basis points. We still have this massive inversion. Specifically on the U.S. 1 year and the U.S. 6 month, they're well over 4% at 4.75 and 4.71 respectively. Where we're looking at the long end of the yield curve, which is just lame in comparison. So 30 years out, you can take out a 30 year for 3.9, and you can take out a 6 months for 4.75. So, I mean, that's a big yield curve inversion. Dollar index today, 104.41 and rising. And thank you guys for listening to my show. Like and subscribe, and we'll catch you guys in the next episode. Bye-bye.